our asset managers. We've got Pete. What Vista is within the stress, distress, or special sit space. What is the most attractive to you right now in terms of the asset class or opportunity that your firm is looking at?
Sure. So, at Vista, we are focused almost entirely on the enterprise software market. And for us, where we're seeing real opportunity and we're seeing alpha is finding less competed markets in credit. I spent a lot of my career as a public distressed debt investor. It's a very, very difficult market. It's well trafficked. I think you have a lot of very smart people who are looking at it. I like to think of myself as a little bit reformed at this point. Where I want to go is where there's less competition. And for us, across software, what you have today is actually a very healthy fundamental picture from the economy, from the sales motion, and in particular from the operating margin perspective in software. What we do have is a lot of dislocation. The IPO market is shut. It's shut for any company that's less than $10 billion in enterprise value, and the reality is that there are 100,000 software companies in North America, and 97% of them are private. We also have a growth equity community that is sitting on the sidelines. They've retrenched into earlier stage venture capital because that's where they feel like they can make outsized returns. And we have Silicon Valley Bank, which has collapsed. And so from our perspective, we have healthy performing companies. I'm going to lean into the special situation side of this panel versus distressed. We have very healthy performing companies that traditionally had about $40 billion of capital supply from US IPOs and from late stage growth equity managers. That's just gone. And for us, what that means is very little competition, an ability to structure higher yielding deals in the 15 to 20% category with very low leverage and tight documents. And so our real perspective is go find the pieces of the market that are less competed. You don't need to stretch on thesis complexity. You don't need to go into difficult geographies, underwrite operational turnaround, or try to get a legal process correct when there are thousands of smart desk lawyers and analysts looking at the same situations. Go into markets that are less covered and less competed.
Great. Now, Niels is with Fortress, and you have a broader credit platform. Kind of same question. Across the entire complex at Fortress, what's kind of sticking out in the opportunity set today?
Well, Drew, to kind of set the background a little bit, the way we're kind of seeing the environment is, we've come off of a 10, 11, 12 year, massive global financial science experiment that, we've never really done in force of society before, meaning, in response to the GFC, globally central banks dropped interest rates to zero, have effectively kind of kept them there for 12, 13 years, then flooded the system with quantitative easing programs. And that's kind of reversed now at this point, right? We've transitioned to kind of a higher interest rate environment. And I think our view is that this is not fatal for the system, but it is painful. And when you think about it, you have quite a number of businesses, quite a number of assets, capital structures, et cetera, that are predicated on zero interest rates, and a lot of investment professionals, quite frankly, as well, that have been in the industry the last decade that are just kind of used to kind of money not costing anything. It's been a little bit surprising to us, actually, the last year to kind of listen to the market kind of pine for a return to kind of low interest rate environment. We don't necessarily kind of see that being needed or happening. So we're seeing a lot of opportunity kind of across the board in a number of different asset classes. I would say the kind of star of the show from our standpoint right now appears to be commercial real estate. You've got just a tough wall of maturities kind of coming up, something in the order of 1.3, 1.4, maybe 1.5 trillion. I've heard a couple of different numbers here today, but that level of maturity coming up by the end of next year. This is, again, against the backdrop of kind of the cost of that capital has doubled and in some instances kind of tripled. Valuations are down anywhere from kind of 20 to 30%. The principal provider of liquidity for the last decade, which has been kind of small commercial, small and regional banks just kind of exited the field now at this point. So we see kind of, quite a significant amount of death and destruction kind of coming in the commercial real estate space. We kind of represent it in a whole host of different ways. We're looking at kind of structured finance opportunities in the SASBs. We're buyers of loans out of banks, so we think there'll be a lot more of that. We'll be the lender to the new owners in many instances. And I think maybe a little bit further down the road, we'll have the opportunity to kind of buy out platforms as well. So I think that's one of the principal ones that we're spending a lot of time on. But then in addition to that, things like legal assets, intellectual property, European non-performing loans, and being kind of a direct lender or credit provider to a whole host of groups that are impacted by this kind of shift to a higher interest rate environment. So it's broad.
So Pete had mentioned at Vista that you're looking for a 15 to 20% return with something like a more of a stressed commercial real estate opportunity. What kind of target returns would you be shooting for, bare minimum?
These days for us, the ante, depending on the investment committee and the pool of capital that we're talking about, but it is, I would say kind of is a minimum kind of, mid-teens, and in some instances, in some of the more off-the-run type situations like legal assets and intellectual properties, we're going to need something that's going to have a two-handle on it. And we want to be able to solve as well for multiple capital at Fortress. I mean, it was the old adage, you market with IRRs, but you take home and use multiple capital. So we're very focused on that too.
Thanks. Maybe from an allocator's point of view, both Pete and I spoke with a lot of different unique asset classes that are obviously fluctuating in that stress, distress, and special sit space. Megan, which asset class are you currently looking at with your team as an opportunity to add to a portfolio?
I think that the way you described the science experiment that we've got going in terms of the monetary system makes it really challenging right now to get excited about equities, or at least the equity side of things from our perspective. We're going to have some, so you can't kind of avoid it in the allocating side of things, but I think private credit broadly, all the stuff you talked about is really exciting right now. Just the fact that you can have a contract, a short duration asset, and get paid nice low-teens, mid-teens type returns for that. I think you're taking a lot less risk than the equity markets, but you're getting what are historically more equity-like returns. So that's an area we're really excited about. But I do think the niche space is fascinating. So the IP assets you mentioned, certain healthcare royalties, other kinds of asset-backed things, because blending just broadly now, I know that's gotten very, very popular. And so it's tough. That feels like it's a little bit more saturated, and so more of the niche under the radar stuff where there aren't as many players in it, I think is really attractive. And one thing we think about, and I was actually thinking about relative to something you said, Pete, which is that less of a cyclical thing, right, where it's just like this is attractive because of where we are in the cycle, or is it more just that space is sort of perpetually underfunded? And so because of that, if you're willing to spend the time to understand those niche assets, you can get outsized returns, less risk, and I think that's a really attractive profile for us.
Thanks. Trevor, same question. Which kind of asset classes are looking a bit more attractive for you on the opportunistic side?
I would agree with Megan. It's interesting because we talk about distress, and we haven't really seen it historically. Numbers have not been good. I mean, last decade's probably 8 to 10% returns in distress, and so those aren't that compelling for taking on that degree of risk. And so when we look at portfolios, from our standpoint, we like real estate credit. We think it's better to be the debt side of it as opposed to the equity side at this moment in time. We like real assets credit. There's some secular trends going on in real assets that warrant the dollars that are there, and lending to that space we think is really attractive. In addition, you have some built-in inflation hedges in that situation also. We like a number of the asset-backed areas because we think they're interesting and they're great diversifiers relative to corporate, just traditional senior lending corporate credit. But at the same time, senior lending, there's some interesting niche areas that we think could be good. Sectors like healthcare, they mentioned, some of the software areas, lending in that particular space, are all pretty interesting. From our standpoint, if you're going to build a portfolio in private credit, being diverse is a good thing. You can have core senior direct lending corporate, but I think you want to sprinkle around that in areas like these.
Now, going into portfolio construction a little bit deeper, you mentioned be diversified in the private credit landscape. but can you actually play some of these? They're a little bit more esoteric niche markets. Are you looking at another diversified fund that's maybe more focused on that space? Are you focused more on LP structures? Are you focused more on interval structures? Ultimately, how are you thinking ultimately 6 months from now when you implement to a portfolio? And then specifically, what asset class would you be kind of taking dollars from?
So we play in the commingled space. We will do structures that are fund of one or SMAs for clients directly. We have clients that accessing this in the secondary environment. So it really depends on kind of what makes sense from a portfolio standpoint and what their inclination are from a structure standpoint. To the second part of your question of what asset classes are you looking at, we definitely we kind of put specialty finance in a big category. And that can include a lot of asset-backed, consumer SME, that can include litigation, healthcare, royalties, and other items like that. We'll have a pretty sizable allocation to that, and we'll access it through particular funds and strategies that do it. That's how we think it makes a lot of sense, and that might all be wrapped up in a client's fund of one, or that could be a situation where it's in a normal account where we just access the commingled fund by themselves.
Great. Megan, same thing. Targeted rifle shots or more spread out?
I think it depends a lot on the asset class. So specifically in the credit space, I really like evergreen structures because let's face it, all the allocators here know that reinvestment risk is a problem, and so I'm pretty sure it should be your problem and not my problem as much. And so it's that space where you can get reasonable pricing and accruals and stuff like that. I think having a more permanent vehicle, and whether that's interval or LP, I think depends a little more on liquidity, how lumpy it is in terms of deployment, and how well you can price the assets. But otherwise, and I think we were getting a tip about this earlier, but I hate evergreen structures for secondaries, for equity, for things like that, where now you're making up a price where I'm supposed to be transacting at that, sometimes on a daily basis, which is my favorite. So it really is just like what's the right fit, and I think that clients can handle. It's all about like the specific client, how much liquidity they can handle. But I actually had a client ask recently because we were upping our niche private lending on assets, and they said, well, how much of this can I have? And it's diversified, lots of funds, lots of loans. And the answer is, I think, more to think about it is like how much you have in equity versus lending. Because it's just loans, right? And so it's a question of if you're diversified, if you can handle the illiquidity, potentially between LP interval structures, whatever it is. But this is a fairly significant percentage of client portfolios for us.
Hey, Drew, can I
Absolutely.
to that too? Evergreen is interesting. We have a number of clients who are asking about evergreen structures. The question should really be, why are you asking about evergreen structures? If you've got some liquidity in other parts of your portfolio, is it liquidity driven? Is it the fact that you have an evergreen and not having a legacy asset, so you actually buying into a marketplace that's much healthier, depending on the asset class? All those are key questions. Asset liability issues, mismatch is a big issue that's there as well. When do you get your liquidity? There's these hybrid structures where you're locked in for 3 years and then you can get money out and it's harvested over time. Is it truly liquid where you can get your money out within a year? So all of those discussions are important. And to say what's driving your need for evergreen, other than the fact that you think you don't want to re-up for the commingled fund. I think you have to have a much deeper understanding of why the evergreen is there.
That is a good point. I would say too, on the evergreen, anything private, my preference is that any evergreen manager should be prepared for it to become a closed-end fund if the world changed and things kind of don't go well, essentially. Like that's sort of the perfect structure, right? Everything's good to your point that you're happy to buy into the existing portfolio, keep reinvesting, and then in the event the world changes meaningfully, let it roll off. Essentially let that be the back end liquidity and then raise the next fund and get ready to go. That is a much harder sell if they go and register it and make it an interval fund, because I'm doing that now and it sucks. So I don't think people are going to unwind that easily.
Yeah, I think a lot of the lessons were learned with the Third Avenue Focused Credit Fund being a 40 Act structure with very illiquid, distressed loans in there. But maybe the Pete, we've been talking, loans, credit, real estate, but we've seen probably the best example for kind of the dislocation between private and public pricing was actually probably a year and a half ago with real estate. Public REITs, dropped dramatically in September, but a year and a half ago, the private side didn't remark because of the way they're structured. At Vista, are you guys thinking about public versus private when you're looking at your companies, and how are you guys trying to find relative value?
Yeah. So we have a pretty large purview across private credit, public credit, sponsor-backed, non-sponsored. I think we certainly have these interesting moments. I can remember in 2022 listening to the private credit panel at a different conference in Europe, and everyone's talking about how great things are, but they're still lending at SOFR 5, and meanwhile you could buy SOFR 5 paper at 90 cents on the dollar in secondary, right? And so I think having the discipline to be able to go back and forth, right? We've certainly, as a credit platform, we have a BDC on our platform, and we've had a lot of dialogue with investors and clients around, whether they want to access that market by buying a discounted NAV in the public market, or whether they want to start with a fresh portfolio, right, and not have to worry about what exists there. So for us, I think really being able to be across both private and public, across different origination channels. We're also attached to a very large private equity business, a $90 billion private equity business, and so we're watching them navigate the opportunity set between take privates in equity land or dealing with private company shareholders who maybe don't have reality yet around valuations. And what we've learned from that is that you just have to be prepared to look at that dislocation and watch it, and certainly it affords a lot of discipline when you have the ability to do more than one thing. I'm a big believer that someone tells you they're going to do IP finance, they're only going to do IP finance whether it's a good time to do it or not, right? And so from our perspective, we have a lot of depth from a domain and a sector perspective, but how we express that, we need to be very flexible for exactly that reason.
And Niels, private, public, where are you guys shopping?
Well, Fortress definitely has kind of a reputation, well earned for spending most of our time in the kind of private credit markets. But frankly, I would say probably our preference is for the public markets. However, we really only love the public markets when it's a dumpster fire. Like, when it's kind of on sale. We have a reputation of being quite opportunistic. So we love the public markets when they're on sale. The kind of tragedy for us the last, 22 years is there's only been kind of a handful of periods. And so what we've done instead is kind of just toiled away in the kind of private credit markets and been able to make very kind of attractive risk-adjusted returns. Private markets are tough. It's bilaterally negotiated. You have to source it. You got to go back and forth. There's calls with Houlihan and Lokey, and then there's with Skadden. It just takes time. And so what we've done is kind of set up our team where we operate across the entire credit spectrum all of the time, and put ourselves in a position that when the public markets do break, that we're ready to go. And so it was interesting in the kind of period 2018-19 up until I think it was the first week of March 2020. Everything we've been doing was in the public market. It was in the private market space. There was just nothing going on in the public world. And then that second, third week of March, the bottom just fell out of the world. But thankfully, from our perspective, we were ready to go by virtue of the fact that we were conversant in the kind of public credit world, the broadly syndicated loan market. We were able to put together short lists very, very kind of quickly. And then, for better or worse, that kind of opportunity lasted for kind of a 2.5 month kind of time frame. And then it morphed back into kind of the kind of private world. So, we'd like to see more dislocations in the public space. Maybe central banks have gotten kind of comfortable keeping their thumb off the scale here recently. But that being said, and I'm speaking poorly on the private markets, there's great risk-adjusted returns. Some of the categories I mentioned, like in the legal assets category, we're able to kind of put together facilities for groups and provide a solution where, our loan to value is in the order of, 20 to 30%. Thereabouts the kind of collateral, and you're still able to extract rates that look like kind of mid to higher teens. And from the counterparty standpoint, that's actually kind of value add because their ROA on it is on the opportunity is more along the lines of kind of the 20s. So us providing financing at that level is quite attractive for them. So it's just easier in the public markets. you know, the supermarkets pre-packed the goods and they're ready to go, so to speak. We just need a discount.
I think that I just want to pick up on one thing there. Like I agree. I think you can have moments, right, where you want to be shopping in public credit. I think my own view on this current sort of whether or not we're going to have a distress cycle or not, you know, it's hard not to look at, say, 20 years ago, and there was a real arbitrage and advantage for distress shops because they could attend a court and, frankly, call on a mobile phone, and that's been, you know, arbitraged out by the market, you know, pretty quickly, and now you have lots of research programs. 2008, you had, frankly, regulatory capture, right, where banks had a lot of loans on their balance sheet, CLOs were not, you know, structured in a way where they could really restructure or own take-back paper, and so there were, like, really obvious sort of easy, almost macro trades to be had in public distress. I think now it's sort of harder to see where those are, right? Now you just have to be a better underwriter of a business than 1,000 other people, or you have to be fast, right? And so you can be very fast, you know, as a large manager like Fortress, where you see a lot, you can price relative value very quickly. I think we can be fast, you know, because of our domain expertise, but I think it'd be a really hard market for a generalist distress manager. I just don't know, frankly, what this, I know this is sort of a tough term to use these days, but I don't know what the edge is, right? There's not sort of an obvious arbitrage that the distress community has anymore. There's a lot of competition in the market.
Very true, which kind of goes to, as allocators there, I know you guys also participate for manager diligence. You know, what are you looking for in terms of traits for the managers that you're looking at in this space? Like, is it an advantage to have, like, for something like a Vista that has both an equity side component as well as the credit side, and be able to underwrite both sides? You know, kind of walk me through what you guys are kind of looking at. Maybe Trevor?
It's nice to have individuals and firms that understand operating companies. And so that is a positive. I want to say it's an advantage. I don't want to say it's a disadvantage for a firm that doesn't have private equity arm, because if they're doing good underwriting, it's still a benefit. So the key is, do they understand the companies? Do they understand the spaces that's there? And if things were to go awry, do they have the groups internally that can deal with it, right? There has been a lot of defaults. So everybody says, oh, I got 0 defaults. And the question really is how much stresses have you really had, truthfully, and how have you dealt with that? And we find that firms that don't have the necessary groups of people who've had that background and history are going to be challenged when things get worse. And so those are things we look for, very much so, a track record of doing it. And if you do it, how do you go about it? How long will you hold it for, if you have to hold it for? When's the longest, if you had a situation like that, you know, have you done attribution? Is there particular areas that have been more default in your portfolio? Maybe it's a sector that you happen to have an Achilles heel with. We like to have those conversations with our due diligence to get a picture of how they would react in a certain market environment. But the more boots on the ground, the more folks you have in a workout group is important. If you are going to have a private equity and a private credit arm, we want to make sure there's not some captive situation going on there, right? I mean, we want it to be differentiated. You don't want to be on both sides of the deal, but having understanding there is important.
Megan?
I'm still a little traumatized from 2020. This is like a therapy session. Everyone can listen to my pain. Which is, the door was being beaten down, right, about like, distressed, it's here, this is the best opportunity you've ever had in your life, and then it doesn't happen. And so that's really challenging with clients, especially I deal with high net worth families, and so you promise them this amazing opportunity and then it doesn't come, right? And what does that look like? So I think it's tough from that standpoint to get excited about the distress cycle and like, let's go commit capital, especially if you're going to pay fees on it, and hope that it comes. The flip side is, though, that I think having both real estate and lending, I think in a shop is really valuable. In one fund, it's harder just from a pure, like, where does it go in the portfolio and how do you assess kind of, you know, what that risk is and where it is. On the real estate side, which a couple of you guys mentioned, I think it's sort of this game where we have some legacy stuff that's doing well and good fixed rate, you know, lower stuff, and so you're waiting, where I'd love to be able to allocate more, but a little bit waiting for more blood in the streets because it doesn't feel like it's quite here yet. But I think that you have to, it's this chicken and egg game, right? Your managers need to have capital so that they're ready to deploy, but then you don't want to commit until you think it's happening. So there, I think if you can be with a manager that you have experience with and trust, and it's been through multiple cycles, like everyone was saying, I think that's really valuable. There's a group we've been invested with for 20 years, and they have given money back in the past, right, or not raised funds, or just taken a long time to deploy it. So I think there's a lot of trust that they'll wait and be patient, and then if there's blood in the streets, they will pounce and scoop it up. So it's kind of finding that right manager, that right fit.
So maybe a curveball question, because I think we've all touched on certain things like the GFC, the landscape changing dramatically. We did have a slight credit crisis in 2016-17 with energy, a little blip. 2020, yeah, it was there and kind of disappeared very, very quickly. The kind of old adage was like, okay, if high yield spreads are 800, you gotta buy. They'll come back in. We clearly can't get to 800 these days, it seems like, because of the Fed backstop and quantitative easing and policy. So, is the new target 500 basis points? Is it 400 basis points? Everything I've heard over the last 2 years, right? Historically tight spreads, and what do? They just get tighter and tighter and tighter. Anyone want to provide an outlook on that?
Yeah, let me maybe kind of one or two numbers that we're kind of paying attention to. I agree with you on kind of spreads. They have gotten tighter, and it's been interesting kind of watching the kind of cadence of the last 6 months. At the end of last year, it was like, oh, it's all predicated on we've got 7 interest rates cuts coming in 24, and so far this year it's clear no interest rates coming, but that doesn't kind of stop the rally. I think kind of one of our thoughts is that when you look back at kind of the savings and loan and the RTC kind of workout, you had 700 banks, approximately 700 banks in the United States, go away either through consolidation, weekend marriages, or failures. During the global financial crisis, it was more along the lines of 400. Depending on how you want to characterize New York Community Bank, you're up to 4.5 this time around. With the fastest interest rate hike cycle in kind of 40 years. So our sense is that there's going to be more of these coming, and the commercial real estate problem is embedded in a lot of these situations, and is not going to get the necessary kind of fixes anytime soon. So I think kind of our view is we can find 500-600 basis point spread in the kind of private credit market. Our sense is that kind of between the kind of demi-world of public and private credit, that this kind of banking kind of situation will hopefully kind of give us, it's going to be more kind of readily available. But, we think you could see a situation like you did during the RTC workout where commercial real estate values go down and stay down for a period of time. I think, we've all gotten used to the last 20 odd years for the V, right? People aren't used to the L as much, so I'd say keep an eye out for that.
Great, we've got about a minute left, and so we're going to do a little quick speed one. Megan talked about blood on the streets, and I think for all of us, right, opportunity has been waiting. Now, obviously with Fed guidance, looks like it might be adjusting market expectations. Right, you mentioned earlier this year, 7 rate cuts was kind of priced in the marketplace. Clearly that's dwindled down to 3 or 2 at this point. Is the max pain here? Pete, with you, is it now, or is it 6 months, 12 months, 18 months? What's kind of your shot?
I don't think max pain's here. I think you've got a lot of the credit market that's presumed that we're going to go back to rate cuts very quickly and things are going to normalize meaningfully lower than where we are. You see a lot of amendments for PIC. We're going to give private equity another 2 years to sort of fix this, but fundamentally the cap structures are a little bit over-levered, and then obviously, I said this earlier talking to someone, I don't know how long, the U.S. economy's been amazingly strong. It's incredible what the Fed did for the U.S. consumer in 2020, but I don't know how long we can decouple from China slowing down as an economy in the U.S., and so I think there's a lot more to watch in 24 and 25.
Megan, more blood or max pain?
I have no idea. And because of that, I'm just going to be in stuff where it's short duration, and I'm going to get paid really well, and there's assets I can go get, and I'm going to sit here and be happy with my total.
Flip the coupon. Niels.
Long-term bullish on America. You always have to be, but it feels like for the next 12 24 months with these maturity walls, particularly the real estate one coming up. I mean, the headwinds are pretty rough, so batten down the hatches.
Trevor?
I have no idea, like Megan. But I will say this. I don't know if it's max pain. I think it's struggles for bad businesses. I'll put it this way. I think good companies will be able to weather the storm and work through that. I think you're seeing PE investors who are now re-upping for certain situations, and they're saying, "I'll let this one go by the wayside. I'm going to support this one." I think in the next year and a half, we're going to see people working through the weak and the strong. And I think that's what you're going to see. So the weak, you're going to see that a lot of pain. The strong will be able to work through some of that. I think the combination will be okay.
Well, thank you all for participating on this panel. Very insightful, and I hope you all enjoyed it.